Hi, everyone. Thanks so much for joining the session. My name is Thomas Kamei. I'm an investor at Morgan Stanley Investment Management's Counterpoint Global funds. We manage long-only equity portfolios with a growth kind of orientation, and we're multi-cap investors. So we manage small, mid, and large cap funds and are very active. So we have a relatively concentrated book. Just by way of introduction, I've been on the team for 10 years. When I joined, I spent the first 8 years of my career there covering the internet sector. So picking stocks, kind of with a digital bent. And for the last, 7 years, have led our sustainability research efforts. I became the head of sustainability research, which became my full-time role about 4 years ago. And I'm really excited to kind of share with you all that what we've been working on there. Specifically, this is content that we created in partnership with the Aspen Institute, specifically the First Movers Fellowship. What we had found was a lot of times sustainability operators would come and realize while their work was driving value, quote unquote, they didn't necessarily know how to articulate that value to their CFOs, the ones who were proverbially kind of figuring out how to deploy capital. So a lot of this framework was developed there, and I hope that it's helpful to you all, as I know that there are many future practitioners in the room. We'll go to the next slide, please. So just kind of give an overview of what we'll kind of talk about in these 18 minutes from here. Really just three parts. Part one is a little bit to give a context overview of how we see the sustainability landscape and where do we see it evolving to. Number two is all about strategy. So again, this is how we're advising portfolio companies on narrative design. And lastly is around tactics. So how are the best-in-class companies articulating their sustainability strategies, both qualitatively and quantitatively? So we'll go to the next slide, please. So again, part one is just all about a little bit of the landscape view. And what we want is all of our portfolio companies to very much skate to where the puck is going. And we'll also give you a little bit of our theory of change. Next slide, please. So really just to kind of set us up, I know there are a lot of believers in the room, but many organizations that you'll join eventually will be more ESG or sustainability skeptical. So we always want to set the stage by making the financial case for sustainability. So very much we see that there's kind of two waves that have happened. And let's go back to 2010. We saw that there was a digital wave that was coming through the economy. These were a set of technological evolutions that were creating new business model forms. And out of those new business models, we created a couple $1 trillion of equity value. Kind of as exemplified by, the Amazon Web Services or, companies like Uber, who were able to capitalize on GPS chips and the proliferation of mobile devices. Let's roll forward 10 years. We think that there's a new wave that's coming through the economy. It's not a technological one, but a cultural one. Just like having consumers who are more environmentally conscious. And that's effectively creating a new set of ways that businesses are differentiating. And just as there were companies that were capitalized on the last wave, we think that there are a certain set of companies that are disproportionately set to benefit as sustainability becomes more important. We'll go to the next slide, please. So I think it's a very fair question as to why does sustainability stick this time when it necessarily hasn't stuck in the past. And we really see the economy through this 4-stakeholder model of consumers, companies, investors, and asset owners. From the consumer side, millennials are $1.4 trillion of consumer discretionary spend in the United States. They're 50% of the US workforce, and 75% of millennials will take a pay cut to work for a purposeful business. And so what that tells us is that the best set of companies now are learning how to cater to this consumer class and attract and retain this talent. So it's our view that investors, active investors who are out there setting price on equity and picking stocks, need to identify and create heuristics to find those companies early. And then it's our responsibility to teach our clients and asset owners that ESG or sustainability doesn't need to be a set of reductive tools, but can actually be a set of strategies to identify great businesses that will make for really great investments. And you can't forget that asset owners ultimately represent consumers. And we're about to undergo the single largest wealth transfer in the history of humanity, $30 trillion under management being transferred to millennials in the next 20 years. And everything is pointing to the fact that they are going to invest very similarly to how they consume, which is values aligned. We'll go to the next slide, please. So kind of double clicking on that investor box, we actually think that we're entering the third wave. Wave one goes all the way back to the 80s. That was SRI, socially responsible investing. And again, I think it's really important to kind of describe these right now so we can all harmonize on language. So if SRI was wave one, that was always going to be a niche product because it was pretty well understood that if you excluded certain stocks from your investable universe, that you were going to encounter a performance headwind. I would point to the Bernstein quant work to kind of validate that. And if that really brought up what we see as wave two, which was all about ESG scores. We think of this in many ways as a transitional technology. This was a way that you could get market-based returns and own fewer quote unquote bad companies as defined by the third-party rating agencies. And these would be companies that would have outsized risks from E, S, and G. The problem with this ESG as a methodology was it predominantly required to use self-reported data, and two, that we just fundamentally believe that impact is not necessarily fungible. We'll get into that a little bit more later. But what that does set us up for is this next wave, which is all about sustainability integration. So it's how do you identify ways that sustainability is driving business value? And we actually think that there is a wave that kind of follows on beyond that, which is all about partnership. And if we have time, we'll try to get to that too. Next slide, please. So at Counterpoint Global, this is what we've built. This is our set of qualitative and quantitative processes as it relates to sustainability research. So we actually study sustainability optionality for every single portfolio in the company, every single portfolio company in the fund, where we really try to understand what are the most material opportunities and risks that sustainability themes present. So again, if you're kind of looking at this slide at the top left, wave one and wave two were kind of these filters. It's like, did it clear our threshold for E screen, our S screen, our G screen? Then you have this reduced investment universe. What we really stand for is the right side of the screen, the prism, the Pink Floyd graphic, where we're looking at how does environmental and societal initiatives within businesses drive one of four flavors of value. And we believe that there are only four flavors. There's moat, like does the initiative drive the durable competitive advantage around the business? Does it provide growth, which is a new market or a new market and market opportunity? Efficiency, which is essentially profitability, the margin profile of your business, or some form of thematic optionality. And what we say is, if as a company or as investors, if we can't understand how your sustainability work is driving one of those four flavors of enterprise value, we consider it CSR or charity, which is fine, but we actually can't give you credit for that in how we're valuing your stock. So these are the qualitative kind of set of processes. It's all about identifying positive sustainability optionality. But we also have a set of quantitative processes. I don't think we'll have time to talk about them today because we don't have that much time. But you're welcome to read about these. If you just Google Counterpoint Global Convergence, you can see our series. Maybe at a high level on the environmental front, in partnership with MIT's Joint Program for the Science and Policy of Global Change, we created a methodology to internalize carbon emissions on long-term net income margin assumptions and thus valuation, and estimate kind of the fact that we run really low carbon intensity portfolios, what a carbon tax would actually do to benefit our funds. Number two is something that we worked on closely with another speaker at the conference, Professor Ethan Rowan from Harvard Business School, but this is our culture quant methodology. This is about looking at companies and their ability to retain talent as a forward proxy for culture. And we were actually able to show the correlation between companies that retain their talent really well and their stock price outperforming. And we actually think that there might be a causal relationship too. In short, if you are a top quintile retention company and you're improving year on year, you drive alpha in your stock price the next year 56% of the time. Interestingly, converse is true too. So if you're a company that is really bad at retaining your talent and you get worse year on year, it turns out that you drive negative alpha 77% of the time. So again, really interesting study. But you can read about that more deeply later. Maybe we'll go to the next slide, please. So again, that all sounds really nice, like glossy asset manager slides, but a lot of times companies actually want to see what we look at every day, and we just wanted to show what our dashboard looks like. So this is what synthesizes together all of our different forms of sustainability research. So our CIO and the other senior portfolio managers on the team can really understand if we think that this company is disproportionately set to benefit from sustainability themes. Go to the next slide, please. So I know that I'm being mindful of time, but I'll try to blast through this because I know that this is also useful, hopefully useful at least. Number two is all about narrative design. And what we tell our portfolio companies is that it's really your responsibility to define your own sustainability narrative, because if you don't, you'll be sentenced to one, or one will be defined for you. So we'll go to the next slide. So again, kind of like going back to that framework of how do you integrate from an investor perspective, I actually think that this is the best companies are learning how to do this. And in fact, we're helping a couple hundred companies kind of along these journeys. But really, it's all about framing your environmental and societal work as it relates to moat, growth, profitability, or theme, or risk. So that would be the inverse. So if you don't do these projects, do you erode your moat? Do you shrink your growth opportunities? Do you delever your business, or do you miss out on that thematic optionality? We'll go to the next slide, please. So we'll just kind of talk about two quick examples. First one is Ball Corp. It's a portfolio company. They are the world's largest manufacturer of aluminum cans. And aluminum is a really great packaging material because it's recycled very often. So in the United States, single-use plastic water bottles, for instance, are recaptured about 10% of the time, while aluminum is closer to 90%. And that's because there's actually value in the scrap. So aluminum is infinitely recyclable, and you pick up your X number of pennies, for each one of these you recapture. So you've incentivized people to pick it out of the waste stream. What's really interesting is this product that's highlighted here on the right is called an Alumatech bottle. It carries roughly 2x the gross profit dollars per unit than the aluminum can. And so all of a sudden, Ball Corp is set to disproportionately have a growth opportunity as it captures the single-use plastic water bottle market, and experiences a really nice profitability tailwind as well. We'll go to the next slide. Totally different company is Mercado Libre, which is effectively the eBay of Latin America, and they still own effectively their PayPal unit. What they have really oriented their sustainability work around is how every incremental user that they bring into their ecosystem is getting financial services. And, in Brazil or other countries like Argentina and Mexico, where they have a big presence, these tend to be countries where the populations are underserved from the banking services. So they actually see that they're providing socioeconomic empowerment with every single person they bring into their ecosystem. And as it turns out, if you have a stored value in your Mercado Pago wallet, you're more likely to transact in the marketplace, which again kind of spins the flywheel. We'll go to the next slide. So again, broadly, what we believe is that operators used to be making business decisions along a singular axis. They were making the decision to invest in something because it drove a high tangible return on invested capital, or it was low returns on invested capital. What we're making the argument is that that impact, doing something positive for society or the environment, is just a form of intangible value. And why is that important to start kind of using that nomenclature? Is because it creates this series, this sequence of change, kind of as captured in the right graphic. Obviously we want to go after all the opportunities that present really high business value, returns on invested capital, and does something very impactful. That ultimately sets us up. We call that the low-hanging fruit box. The second one is the win-wins, right? So these are things that tend to be good, are okay for the business and are impactful. And ideally, if we've started to teach our companies and leadership teams on how to go after those opportunities, it sets us up for what is the bigger end goal of sustainability as it relates to business, which is to go after these white whales, which are the things that are extremely impactful and might not pay back from a return on invested capital perspective quickly, but it's something that's so impactful that it's something that we ultimately want to go do. We'll go to the next slide, please. And again, we just really believe in this whole idea of partnership, finding companies that where maybe our expertise or our worldview across all sectors, all caps, might be able to provide an interesting lens. And, Ball Corp, a company that we admire a lot, it was a real honor to write a section of their sustainability report last year and, get some nice gratitude from the operators. Next slide. Yeah, another case study with Uber, which is a controversial company. But maybe we'll just go to the next slide, just because I know that we're running out of time. One more forward, please. So again, so we'll just try to hit this one really quickly. So the whole part 3 is about tactics. So what are the best companies out there doing in order to really articulate that they are in fact being impactful? We'll go to the next slide, please. So why at Counterpoint Global, we focus disproportionate amount of our time on culture rather than quote unquote ESG data. And again, it's predominantly because we don't believe that the data is all that complete, because it tends to be, or it is self-reported. And then secondarily, we question the wisdom of really trying to trying to size impact when, impact is not necessarily fungible. So, it's great to take 3,000 tons of plastic out of the ocean. It's great to secure the firewalls of 3,000 enterprises and empower 3,000 small merchants. But how do you compare those to each other? So that's why we spend our time looking at what we call cultures of adaptability. So these are companies that have all 5 of these things. They have aligned purpose, long-term orientation, authority, disclosure, and inclusion. We'll go to the next slide, please. So, just as an example, when it comes to long-term cultures, we look at how companies are incentivized. So, we look at Estee Lauder as an example of this, kind of this family-owned mindset. The vesting schedules of deferred compensation is 7 years. Amazon is also famously kind of in that range too, but it really starts to symbolize how they're trying to get and incentivize their leadership teams to be thinking longer term. Go to the next slide. Purpose is also extremely important. It doesn't matter if you're selling $3,000 Brunello Cucinelli sweaters or surgical robots. Being able to articulate exactly how decisions get made and what is the purpose or mission of the enterprise can be very clarifying on how capital ultimately gets allocated. And we think that, for instance, like Intuitive Surgical captured here, that's the chief medical officer and the chief financial officer both have very strong says in what they ultimately go and deploy research dollars against. So if there is a procedure that is so impactful for the end users, even if it's a small end market, they can still justify the research and development. Next slide, please. Okay, I'm running out of time. Authority. We think that companies figuring out how to make sure that their sustainability leaders have agency to be disruptive in their organizations is important. So we look at Union Pacific as an interesting example where their chief operating officer is also their chief sustainability officer. Next slide. Inclusion. We think that companies, it's one thing to put out a diversity, equity, and inclusion report. It's different to actually see it as a form of durable competitive advantage. We would point to the Jack Dorsey companies as being particularly strong here. They really see that their ability to attract and retain talent and find talent from underrepresented communities as a form of them being able to have an advantage for recruiting and engineering talent in Silicon Valley, which is obviously a very competitive market. Next slide. And disclosure. So, here's a quick list of some companies that we think do a particularly strong job with their sustainability reports. I would point to Etsy as a particularly strong one where they have a fully integrated 10K where every one of their sustainability projects, they directly tie to what is their mission, which is to drive gross merchandise sales to their small and medium-sized merchants. And so they never take their eye off the ball of their mission, even as it relates to their sustainability disclosure. Next. Here's the alphabet soup of all the different disclosure frameworks as it relates to sustainability. Each have their pros and cons. Again, we're very much proponents of the idea of finding those spaces of alignment. We'll go to the next slide. So we are getting some consolidation on kind of the backward-looking set of methodologies under the ISSB, and we think actually going forward, we're really trying to make the case for this Counterpoint Global-esque methodology of connecting sustainability to these value drivers. And we'll go to one more slide. And this is something that we're about to debut this year, but wanted to give you all a sneak peek. But after having a research effort dedicated to sustainability for the last couple of years and publishing a couple thousand pages of research internally, What's been interesting was we started to identify these themes. We're calling them tailwinds. So these are business activities that are driving business value that also have really impactful positive externalities. And what we're in the process of doing is trying to understand if there is some more comparability, kind of using a bracketing system like this, because E, S, and G is too crude, while the UN SDGs, in our opinion, is a little bit more geared towards development and governmental agencies, rather than being an investor-ready framework. So this is the one that we're putting forward here. Great. Okay, well, I'm 1 minute over, but I believe we have a question or two.
Thomas, why would an asset manager who is mostly incentivized to hoard their best thinking be willing to share this thinking externally?
So the first question on, kind of why are we sharing it's a good question. As I'm sure you're all aware, most of the time investors hold their best ideas close to their vest. We're not really incentivized to share. In fact, it's more tends to be very proprietary. But one of our core beliefs is that we're early in this transition, so it's better to kind of help as many people as you can, kind of be non-zero sum. And we're also concerned that we're maybe going further away from the intended purpose of sustainability, as it was kind of initially conceived. I think that a lot of asset owners would love it if their investments were getting put towards companies that were doing something really impactful and positive for society. So it's like using the power of capitalism to go after the world's most intractable issues. And if we look at what's going on in Europe with SFDR, it's becoming much more of a exercise around disclosure and box checking. So this was another reason why we were happy to kind of put out a new framework that was a little bit more additive.
Thomas, may I interrupt? What is the intention and next plans to utilize sustainability research tailwinds? Could this be a methodology to quantify and compare impact between companies?
Yeah, what is exciting about this is maybe we can start to be able to evaluate companies against and on their positive externalities, and to ultimately figure out which ones are most efficient at driving that impact value. And again, it's about creating a framework that was built for investors to ultimately use comparability. So kind of the analogy for us is if you're a retail investor, and you look at restaurant companies, there's a certain backhand, quick set of heuristics you use to understand a business's quality. What is the four-wall payback? What is same-store sales growth? If you're an internet investor, you might use statistics like what is daily active user count or what is average time spent. But if you're looking at companies that are like tailwind number 3, communities communities and platforms that enable belonging and inclusion, what are this useful set of metrics to evaluate? And so very much as we start to kind of codify this framework, we're hopeful to put out some quantitative and qualitative metrics that we'll share with our portfolio companies to really help us popularize this.